Welcome to this very special edition of the Money Show. It's the Diwali special, where we are coming to you live from our studios on Choti Diwali. So first up, many thanks for tuning in here. We will, through the next 30 minutes, be in conversation with Kalpesh Ashar, a certified financial planner. You've seen him often here on ET Now. As you all know, the Money Show is the first of its kind and the only such show in all of India. Just one aim, to help you all get richer. For the next 30 minutes, our phone lines are open. The number's on your screen. You can call us live and get Kalpesh to answer all of your queries. You can also email us. We're also on social media, Facebook, Twitter. You have enough options. Get down to it. Kalpesh, happy Diwali. Many thanks for joining us here on ET Now in this very special edition of the Money Show. So let's get straight down to it. I want to understand from you, before I get down to specific viewer queries, what are you advising your clients? Look what has happened in the equity markets. Look at the fears that are surrounding NBFCs, the mutual fund industry at large, the liquidity crisis. Real estate has not recovered since the Lehman crisis. What are you advising them? What is the best asset class according to you today? What kind of a portfolio allocation are you telling them as we head into the new Samvat?
So first of all, very happy Diwali to you and to all the viewers of ET Now. And it's a great occasion where all the spirits are high and everyone is looking forward to all the festivities. But like you rightly said, the spirits of the investors are not really in great shape. So keeping that in mind and considering that, we as certified financial planners or CFPs look at the individual's profile on the first basis. And keeping that in mind, what is important to us is the investors or the client's goals. And once we have that roadmap laid out, really any investor who has projected his short-term or his long-term goals would not be really worried. Obviously, the jerks would be there, what the equity markets have been giving us since the past couple of months. The debt yields have been just going through the roof, and we are touching almost 8% now. So given all that, a investor or a client who has got his financial planning in place would really not be exactly, I would say, shaken up by these events. Now, keeping that in mind, the question which you asked, what are we advising our clients or the investors, is a simple thing that, the investors have evolved in the last, I would say, 8 to 10 years since the last collapse of the Lehman Brothers 2008. So in that, we've seen the SIPs, the MF investors, first of all, not actually heeding to the advice, but feeling very circumspect, feeling very scared, and then slowly starting to wet their feet through the SIP route. So those investors who have started their journey, say, way back in 2009-10, I think they are still not at all worried about what's happening in the markets. They have now been seasoned investors and they know this is a phase and this too shall pass. Now, the people who've actually come in the last 1 or 2 years are really a worried lot, and I don't blame them, because they've never seen a fall as much as what we've seen, like the index crashing by almost 10 to 12%, and the mid caps and small caps are all over the place. This is where the hand holding comes into the picture. This is where the asset allocation comes into the picture, and most importantly, like I said, that if their goals are laid out, so if they have projected their investments for, say, a short-term goal, they would not be in equity investments for anything between a time horizon of, say, 15 days to even up to 3 years. Their investments should be in fixed income, and anybody who's got a horizon of, say, 3, 5 and 10 years type of a thing should have his investments in equity. So given that perspective, I think if the investors or the clients have their goals laid out, the purpose has been achieved why they're investing their money, I think these type of market conditions would be taken in their stride.
Yeah. Okay. So that's a generic advice for all of you viewers looking to get richer, especially as the new Samvat begins. But as I promised you, we will be taking viewer queries here on the Money Show. Let's get down to it. Prajwal has written in to us saying mutual funds are launching campaigns around the advantages of starting an SIP this Diwali. But how do I choose the right mutual fund for my goals? The goals have been sent to us. What is the criteria to look at? He wants to save for his daughter's wedding over the next 8 years and has specifically pointed out that he's a conservative investor. Kalpesh, what would your advice be? He's told you the goal, he's told you the time horizon is 8 years and that he's quite conservative.
Given that you have a time horizon which is actually quite good, you know, and also you've labeled yourself as a conservative investor, my suggestion would be that you can look at an asset allocation of say 50% of your investments in equity and 50% in fixed income space. So in the equity portions, you could have a look at the mutual funds which are tilted towards the large cap and the balanced categories and obviously the multi caps. And in the fixed income space, surely debt funds is the way to go for you out here, because we all know that, you know, after 3 years, the debt funds offer the indexation benefit, which is 20%. And given that it's got an advantage over the conventional FDs, which we have always been investing in. So you could have a mix of these two. The funds which I could recommend out here is the ICICI Prudential Blue Chip Fund for the large cap category, and the other one is the SBI Focused Equity Fund in the multi cap category. And also you could look at in the balanced fund category, the ICICI Prudential Balanced Advantage Fund. So you could have a mix of these three funds. And in the debt funds, don't look at very high duration type of funds. I think a short duration or a medium term fund should do good for you. And because you have not ventured to take a higher risk profile, that's the funds I'm recommending to you. And the other thing is that should you start an SIP this Diwali, I think the time to start an SIP in a mutual fund is as early as yesterday. So even if you are trying to think about it that Diwali is an auspicious occasion, so be it, but do not delay the process and commence the process immediately.
SIP yesterday, not today, so get coming in from Kalpesh. Do write back to us if you have any follow-up. I should reduce my exposure to pure equities and look at other asset classes to invest in this Diwali. Is gold better or real estate? Or can you recommend better options? Kalpesh, I know we touched upon this briefly. Yesterday was Dhanteras, the most auspicious time to indeed buy gold. It's an asset class that has struggled also since demonetization. The second anniversary of demonetization is also coming up. How would you answer this one?
See, you know, when you say the word gold, I think we all Indians have a very long association. In fact, a very, I would say, lovely association with gold now for ages. And it's moving on from generation to generation, and it just doesn't seem to end. But we now have to take cognizance of the fact that there are really better, effective asset classes where we can have our money move much more faster than what gold is. Nobody is taking away the advantage of gold, which is liquidity, the spiritual aspect of it, that it's very advantageous to invest in occasion like Dhanteras or Diwali. I'm not taking those aspects at all into consideration. But gold being what it is, we have just to say that it's a hedge against inflation. And the sooner we get out of the mindset that gold can be construed as a pure investment, the better for us. I think gold, when people buy, they need to first differentiate between whether they are buying gold for their decorative purpose, for their jewelry to look good as a status symbol, so be it. But do not construe that as an investment option. Because when you label it as an investment option, I always would suggest that you do not have an exposure of gold more than 10% in your portfolio. So, and there are better ways to buy gold now. So we've always talked about ETFs, we've talked about gold-based mutual funds, and obviously the most beneficial now is the one which government has introduced, the sovereign gold bond schemes. So you can have a minimum purchase as low as 1 gram up to 4 kgs as per the criterion of the sovereign gold bonds go. You are getting paid an interest of 2.5% on that. So if you want an exposure to gold, adopt the sovereign gold bond scheme. For a little bit of token happiness, you can buy gold for sure. And coming to real estate, I have seriously an issue with people who weigh gold and real estate same, especially on terms of an occasion, and think of it as a conventional investment, because here gold at least has the advantage that you can go and liquidate gold as per the orthodox thoughts anytime you want. But real estate is not that. It's a highly illiquid asset, difficult to sell, and it takes a real planning. You need a lot of planning, you need a lot of discipline, and you need a lot of time span on your hand when you decide to buy a real estate. So if it's your own house, you go the whole hog and you take a home loan for it, no problem. But I would say that when you buy real estate, you should plan for it for 5 to 10 years. And in fact, on an auspicious day, plan your entry, what we call the Grah Pravesh. So that should be on an auspicious occasion.
The market is dead. Yeah, the market is also dead. It's difficult to flip it as well, to monetize it maybe. But having said that, Kalpesh, I have a very different view. It is one asset class that brings you a lot of security at a time when you have crisis, even if it's a medical emergency. That's the one that you really bank on when you need funds, of a large nature. Let me go across to Tushar now. He's joining us on the phone, and he's got a query for Kalpesh today. Hi, Tushar. Happy Diwali. Thanks for calling in on the Money Show. What's your query?
Yeah, wish both of you a very happy Diwali. My query here is, I have a large exposure to liquid funds from ICICI as well as HDFC. I need the money back in, say, a year or year and a half. So I keep hearing that there is a liquidity crunch and a lot of redemption of liquid funds is happening. Should I stay invested, or should I take out my money?
Kalpesh, what's your advice?
Yeah, so Tushar, I agree with the concern which you have. We've had these NBFC issues propping up, and factually speaking, a couple of ultra short-term funds or the liquid funds were under the hammer for a certain period of time, who had exposure to the ILFS papers, and we saw their NAVs go down. Some of them had to write off the ILFS exposure which they had. So I do not completely disagree with your concern, but you can even look at the papers in the liquid fund category or the ultra short term category, study the fact sheets, and go with genuinely good papers. I'm not denying the fact that ILFS was a AAA rated paper and it had been derated down to junk status or whatever it is. So the genuine advice here is that if you're concerned about it, you could remove around 50% of your exposure to liquid funds just for your satisfaction and park it in a conventional FD and leave the remaining 50% in the liquid funds, because I think that crisis has now been looked at properly by the concerned people.
Okay, I do hope that helps out, Tushar. And if you have any more follow-on queries, keep tuning in and calling us in on the Money Show. We have another live caller with us. Our viewer Prabhakar from Bengaluru is dialing in. Hi Prabhakar, good evening. Happy Diwali. Many thanks for joining us here on the Money Show. What's your query for Kalpesh?
So at the first outset, wish you all happy Diwali. My query is that which is the best debt fund for the coming next year, which will be safe without looking after safety as well as returns?
As far as debt funds go, you have to look at it. In fact, it's a very tough job monitoring debt funds rather than equity, So if you say which is the best debt fund, I would not like to name the best debt fund, but here I would like to advise is that at least if you're looking at the next 1 year and the place at which we are, if you have a fixed income portfolio in the debt fund category, I would suggest that you park your money around say 60% in the short term type of funds or the ultra short term ones, and remaining 35 to 40% you could park it in the medium term or the corporate bond fund category. But yet I would surely say that avoid the long term duration funds or the gilt funds.
Okay, so I'm sure that has helped out Prabhakar. Very specific advice has been given, and Prabhakar, happy Diwali. Thanks again for calling in. If you have any follow-up queries, feel free to keep dialing in. I think with that, we have to take a short commercial break. You're watching the Diwali special of The Money Show. We'll be back after 2 minutes. Watching the Diwali special of The Money Show. I'm Nantara Rai in New Delhi. The new Samvat is beginning. We're exploring options on how to get all of you richer. Here's a good alert and something you need to keep in mind and maybe even join in on. The Times Network and the Association of Mutual Funds in India recently launched Jan Nivesh. It's an investor education initiative aimed at getting people to pledge just 1 day's income into mutual funds for the long-term benefits. You can also partner us and be a partner of the growing economy by just pledging 1 day's income. The number's on your screen. Give a missed call to join the Jan Nivesh program. And Kalpesh Ashar is still with us in the studios. He's joined us in the Diwali special edition of The Money Show. I believe we have another live caller with us, Sunil from New Delhi. Hi, Sunil. How can we help you?
I just want to check you for 1 to 2 year horizon, which would be a better option, liquid fund, arbitrage, or ultra short term?
Year horizon, I think you could go for the short term or the low duration funds because as per the new recategorization of SEBI, it's a very specific time frame given, and it's much more easier to choose now when you have your time frames laid out, so you can exactly match your time horizon with the investment, the debt fund investment. And I would like to, suggest the ABS, the Aditya Birla Sun Life Savings Fund, or the Reliance Low Duration Fund. You can go in for that if your time horizon is 1 year.
Okay, Sunil, I do hope that helps you out. Thanks for joining us in this special program of The Money Show. If you have any follow-up queries, keep calling in. You can also email us or join us on our social media handles, whether it's Twitter or Facebook. I believe another live caller is with us, Anshul from Bhopal. Anshul, happy Diwali. How can we help you today on The Money Show?
Hello. Hello.
Yes, Anshul, if you can hear. Yes, Anshul,
Hello.
Carry on. What's your query?
Happy Diwali to the whole team. Actually, I have a query. I just want looking out for a horizon.
Anshul, we can hear you.
It's my horizon is 2 to 3 years, and I'm looking at some investment options better than FDs. The returns on a safer side, but from the market side. So it would be better for liquid funds or some debt funds.
3 years, Anshul?
Hello.
Is your time horizon 3 years?
Yes, maximum 3 years.
Okay, so if your time horizon is 3 years, I think you could go in for the short term or the low duration. I just said that in the previous answer, and it will surely give you a better return than the FDs if the investments are held more than 3 years because you get the indexation benefit out here. And you could also, in fact, if you stretch your time horizon a little bit more, say a couple of years more, you could look at the conservative hybrid balanced funds also. So they could give you a little bit better alpha, but for that I would suggest you have a time horizon of around 5 years. But for 3 years, you better stick to the short term or the low duration funds.
I'm going to ask you a follow-up question on behalf of Anshul Kalpesh, and allow me to do that. He wants to beat FD. Isn't that one of the easiest things to beat when you're planning your finances?
That should be the debt funds exactly do that, Nantara, and FD, of late has really not been the favorite of many people, and many people have flipped to do this. So going by his risk profile, surely the debt funds, if the people should be able to, prolong their holding period to more than 3 years and then wait for the tax benefit to seep in. That is where the real benefit would come. So if you have that type of a benefit, you could beat your FD returns by a couple of percentage for sure.
Okay. Sunil, I believe we have another live caller with us, Shrikant from Kolkata. Hi, Shrikant. Happy Diwali. Thanks for calling in on this special edition. It's, of course, an auspicious time to invest. But tell us how we can help you today.
Okay. Thank you, ma'am. Good evening to you and happy Diwali to you and sir. Ma'am, I am investing in mutual funds from last 1 year. Total monthly coverage of 11,000. I'm investing in Axis Focus, IDFC, Axis Focus 25, IDFC Focus, and Reliance Focus. In mid-cap category, HDFC mid-cap, Axis mid-cap. In small-cap category, HDFC small-cap, Franklin small-cap, Reliance small-cap, and SBI small-cap. And one thematic fund, SBI consumption, FNC, and in tax saver, IDFC tax saver and Axis tax saver. Now in all this fund, I am investing 11,000 per month. Now I want to invest 2,000 more. Please suggest me whether my portfolio is too much diversified. Some of my friends have suggested that it is too much diversified. Yeah. It may not be good for the future. Plus, I want to I want to add 2,000 more monthly. So kindly suggest what should I follow.
Shrikant, I think your friends who have advised you are right, because you already are investing in too many funds for the amount which you specified. And fundamentally speaking, you know, when you invest in mutual funds, you are already diversifying your investments across various market caps. So you genuinely do not need to have so many funds, 10 to 11 funds in your portfolio, because what it happens is it just duplicates your investments. You just add up doing more paperwork, and it shows on your portfolio also. So seriously, you need to cut down on around 5 to 6 funds. And what I would suggest is that you can continue with that ELSS fund, because that is for the tax saving purpose. And from each category, the choice of funds which you have, let me tell you whatever you told me quickly. The choice of funds is not bad, it's good, but you need to take a call on cutting down at least 5 to 6 funds. You can have a portfolio of 3 to 5 funds maximum plus one ELSS. And the 2,000, whichever according to your risk profile, if you have a higher time horizon, a longer time horizon, you can add it in the mid and small cap category also, because you want to stay invested. And that right now it's a beaten down category, so you could take an exposure there.
Shrikant, I do hope that helps you out. Kalpesh, of the view that you have your eggs in too many baskets, you need to consolidate, and especially for the money that you're talking about. If you have any follow-up queries, please feel free to keep calling in. You can write to us as well on our email address or on Facebook or on Twitter. Kalpesh, thanks so much for joining us here in our studios for this special edition of The Money Show on Choti Diwali. We're completely out of time, so here's wishing all of our viewers a very happy Diwali, pots of gold, great health and tons of happiness.